There's a number the financial industry would prefer you never sit down and calculate. It's the gap between what you have saved right now and what you were quietly told somewhere in your 30s that you were supposed to have by now. Maybe you felt it. That low hum in the back of your mind when a commercial shows a couple your age sailing into a sunset they clearly paid for in full. You're 48 or 53 or 57. You did most of the right things. And somehow the math still feels like it's behind you instead of in front of you. So you start looking. And every video, every advisor, every app asks you the same question. Which investment should I pick? Stocks, real estate, crypto, gold, index funds. As if the whole game came down to choosing the right horse. Here's what nobody tells you. After 40, the asset you choose matters far less than the order you build things in. Picking the winner is not the skill. Sequencing is the skill, and almost no one explains it because there's no commission in it for them. You don't need more money. You need a better plan. Let me show you the blueprint. Let me start with the experiment that gets passed around the internet every year, because understanding why it's misleading is the first crack in the wall. Someone takes $100 and splits it across 5 investments. They wait 4 years. Then they reveal the scoreboard. Bitcoin turned $100 into roughly $650. An index fund tracking the S&P 500 grew to about 180. Gold reached 140. A real estate fund limped to around 110, dividends included. And a single stock, chosen almost at random, actually lost money, ended at 68. The lesson people take away is Bitcoin won, so chase the thing that climbs fastest. That conclusion is exactly backward, and if you're over 40, it could quietly cost you the rest of your working life. Here's the first honest thing I'll tell you. Those numbers describe what happened in one specific 4-year window. They are a photograph, not a forecast. The next 4 years have no obligation to rhyme with the last 4. Anyone who shows you a past return and lets you feel it as a prediction is selling you a feeling, not a strategy. This is where most people get it wrong. Now look closer at that scoreboard because it's hiding the real story. The investment that climbed the most to crypto is also the one that can fall just as fast. Prices in that world have dropped 70–80% inside a single year, more than once. The single stock that lost money wasn't unlucky so much as undiversified. One company, one set of decisions, one point of failure. And the boring index fund that finished in the middle did something the others didn't. It held hundreds of companies at once, so no single failure could take you down. So let me ask the question the scoreboard never asks. Imagine you're 54. You have, let's say, $90,000 set aside. Not a fortune, but real money. Money that took decades to gather. Now picture putting a meaningful slice of it into the asset that can drop 80% in a year. If that drop comes when you're 56, you don't have 30 years to wait for the recovery. You have maybe a decade before you'd like the option to stop working. The volatility that's merely exciting at 25 is genuinely dangerous at 55. Same asset, completely different consequence. The number on the screen is identical. The meaning of that number is not. That's the trap. The scoreboard measures return. It says nothing about who you are when the loss arrives. And after 40, who you are when the loss arrives is the entire game. There's a concept professionals use that almost never makes it into these comparison videos. It's called sequence of returns risk. In plain English, when you're young and still adding money, a market crash is a sale. You keep buying at lower prices and you recover. But when you're older and closer to drawing the money down, The order in which good and bad years arrive can make two people with identical average returns end up in completely different places. A bad stretch early in retirement does damage that a bad stretch later simply doesn't. Two investors, same average return over 20 years. One runs out of money, one dies comfortable. The only difference was the order the years arrived in. The industry doesn't lead with this because it depends on timing, and your age doesn't sell as cleanly as, look how much this went up. But it's the truth that changes everything. So we're going to throw out the scoreboard. For the rest of this video, we won't ask which asset wins. We'll ask a better question, the one a careful adult actually needs answered. What job is each of these 5 investments good at? And which jobs does your money actually need done in the second half of your life? Because a hammer isn't better than a screwdriver. It depends entirely on what's in front of you. And the person who owns one of each and knows which is which builds something that lasts. Let's take the 5 tools one at a time, starting with the one that flatters your ego the most. Individual stocks. Owning a piece of a single company you believe in. I want to be honest about the appeal because it's real. Put $100 into Apple at the right moment a few years back and it would be worth around $170 today. Microsoft, closer to $188. Nvidia, and this is the number that makes people lose their minds, somewhere near $900 from a single $100 bet. You hear a number like that, and something animal wakes up in you. That could have been me. This is where most people get it wrong. Because here's the same coin, other side up. In that famous experiment, the person didn't get to choose Nvidia. He threw a dart at a board of 20 companies and it landed on Samsung. 4 years later, that $100 was worth $67, a 32% loss, while the broad market climbed. Same strategy, same 4 years. The only variable was which company, and that variable is the one you have the least control over. So let me show you the math the highlight reel skip. When you buy one company, you are not buying the stock market. You're concentrating your money into one set of decisions made by people you'll never meet. If the CEO makes a bad acquisition, you pay for it. If a competitor leapfrogs them, you pay for it. If an industry you thought was permanent quietly becomes obsolete, you pay the full price, not a diversified, cushioned version of it. The whole thing. Now, can you reduce that risk? Yes. And here's the part that's genuinely useful. Doing it right means reading the actual financials, income statements, balance sheets, cash flow statements, understanding who runs the company and whether the business actually makes money or just makes headlines. It means treating a single stock as a 2 to 10 year commitment, not a lottery ticket you check every morning. That's real work. It's a skill, and skills take years to build. And that's the honest trade-off nobody states plainly. Individual stocks have the steepest learning curve of all 5 tools. Not moderate, steep. The people who win at this either do the homework for hours every week, or they got lucky and quietly confused luck with skill. Which is the most expensive mistake in all of finance because it makes you bet bigger next time. So here's my honest position for someone over 40. Individual stocks are not forbidden, but they belong in a specific corner of your plan. The small, deliberate slice reserved for genuine conviction, money you could watch fall by half without it touching your sleep or your retirement date. Not the foundation, the accent. There is one thing here worth keeping though, and it's not about stock picking at all. It's the accounts. If you hold these investments inside the right tax-advantaged account, a Roth IRA in the United States, for instance, your gains can grow without the yearly tax drag pulling them down. That structure matters more over 20 years than which company you picked. The container often beats the contents. Remember that. We'll come back to it because it's one of the quiet levers that actually moves the needle. And before we go further, one note of plain honesty about how content like this usually works. When someone shows you a 5-asset comparison and then conveniently points you to one specific app with a sign-up bonus and a referral code, you're no longer watching education. You're watching an advertisement wearing education's clothes. The platform might even be a fine one. But the moment money changes hands behind the scenes, the recommendation stops being neutral. And you deserve to know which is which. I'm not selling you a platform today. I'm trying to sell you a way of thinking. If you fix this, if you stop hunting for the next NVIDIA and start asking what job each dollar is doing, everything changes. So if a single company is the highest skill, highest effort tool in the box, what about the one that promises to pay you just for holding it? That's where we go next. Real estate, and the seductive phrase passive income, a phrase that's true far less often than people are led to believe. Now to the tool that sells the most beautiful dream of all, real estate that pays you while you sleep. No tenants calling at midnight, no leaky roof, just a check that shows up. The vehicle is called a REIT, a real estate investment trust. The idea is genuinely elegant, so let me make it plain. Instead of buying a building yourself, which would take a down payment, a mortgage, a lawyer, and a tolerance for 2 a.m. phone calls, thousands of people pool their money. That pool buys offices, apartment complexes, warehouses, shopping centers. You own a slice of all of it. You're not the landlord of one door. You own a sliver of an entire portfolio of buildings, and the rent flows back to you as dividends. Here's the fact that makes REITs distinct, and it's real. By law, a REIT must pay out at least 90% of its taxable income to shareholders. That's not marketing. That's the structure. It's why REITs are known for relatively high dividends compared to ordinary stocks. For someone over 40 who wants their money to actually produce something, not just sit there hoping to be worth more someday, that income is the entire appeal. But here is where the dream gets sold dishonestly, and I won't do that to you. You'll hear REIT income described as stable and reliable. Those words are doing a lot of lifting they haven't earned. Reliable until what? Go back to that 4-year experiment. The person's REIT didn't soar. It actually slipped about 1.5% in value. The only reason it finished slightly positive was the dividends it paid along the way, roughly $12 on a $100 stake. The income carried it. The price did not. Why did the value drift down? Likely because it held commercial property, offices, during a stretch when the world stopped going to the office. And that's the whole point. A REIT is only as healthy as the buildings inside it and the economy around them. This is where most people get it wrong. Let me give you the honest list of what can crack that reliable income. When interest rates rise, REITs get hit twice. Borrowing costs climb, and suddenly a plain savings account pays nearly as much without any of the risk, so investors flee. When buildings sit empty, vacancy, the rent stops, and the dividend gets cut. When a whole sector struggles, the way malls did or offices did, the buildings inside that REIT struggle with it. The 90% payout rule guarantees they share the income they have. It guarantees nothing about how much income there will be. So let's place this tool correctly. A REIT is medium risk. Genuinely less risky than betting everything on one building you own outright, because you're spread across many properties and many tenants. But less risky than being a solo landlord is a very different sentence from safe. Picture a couple, both 56, who hear real estate and passive income and assume they found a paycheck for retirement. If they lean their whole plan on it and rates spike while vacancies climb, that paycheck shrinks at the exact moment they were counting on it most. The income was real. The certainty was imagined. Here's how I'd actually use it. A REIT is an income tool, not a growth engine and not a savings account. It belongs in the part of your plan where you want cash flowing in, ideally later, as you shift from building wealth to drawing on it. And like the stocks we just discussed, the account it lives in matters enormously, because REIT dividends are normally taxed as ordinary income, which can quietly take a real bite. Hold it in a tax-sheltered account, and you keep far more of what it pays. You don't need more money to make this work. You need a clear idea of what you're actually buying. Income with conditions, not a promise. Notice the pattern forming across these first two tools: stocks, high effort, the accent, REITs, medium risk, the income. Neither is the foundation. We're 3 tools in, and the so-called winners keep turning out to be specialists, each excellent at one job, dangerous when asked to do all of them. Which brings us to the one that breaks the pattern entirely, the one that made ordinary people rich and ordinary people ruined, sometimes in the same year. Part investment, part something else entirely. That's next. Now the tool that breaks every pattern, the one that, in that 4-year experiment, turned $100 into $652, a 552% return. Crypto. I'm going to talk to you about this like an adult, because almost no one does. One side screams it's the future and you're a fool to miss it. The other side calls it a scam and you're a fool to touch it. Both are selling you certainty. The truth lives in the uncomfortable middle. So let me be precise about what it actually is. Cryptocurrencies like Bitcoin are a form of digital money, no government or bank controls, secured by a technology called blockchain. Bitcoin in particular has a fixed, limited supply. There will only ever be so many, which is why people call it digital gold. And it's true that Bitcoin was one of the best performing assets of the past decade. That's the part the believers tell you, and it's accurate. Here's the part they say more quietly. That 600% return is not typical, and I need you to actually absorb that word, not typical. Bitcoin was the exception. Most cryptocurrencies did not do that. Many lost most of their value. A great number went to zero. Total loss, the entire stake gone. The headline winner is shown to you precisely because it's rare. You don't see the thousands of coins that quietly died, because dead coins don't make compelling videos. This is where most people get it wrong. And the volatility is not a footnote. It's the defining feature. Prices in this world can rise 1,000% and fall just as fast. 80% drops have happened, more than once. Now run that against everything we built earlier. If you're 28 and a coin drops 80%, that's a painful survivable lesson. If you're 57 and you put serious money in, an 80% drop isn't a lesson. It can be a permanently rewritten retirement. Same asset, completely different consequence. Exactly the trap we named at the start. Let me also clear up something dressed up to sound safe. You'll hear that crypto pays passive income through staking and lending, locking up your coins or loaning them out for rewards. I want to be very direct. That is not a dividend. A dividend is your share of a real company's real profit. Staking rewards carry protocol risk, platform risk, and counterparty risk stacked on top of an asset that's already wildly volatile. If the platform gets hacked or the coin collapses, the income vanishes, and so can the coins generating it. Calling that passive income puts it in the same mental drawer as a REIT dividend, and they do not belong in the same drawer. Then there's tax and security, and here crypto is genuinely the worst of the five. In the US, even trading one coin for another can be a taxable event, and rewards get taxed as income. You can't shelter it in a Roth IRA the easy way you can a fund. And because it's largely unregulated, if someone hacks your wallet or tricks you into sending coins, there is no bank to call, no fraud department, no reversal. The money is simply gone. Keeping it safe is its own skill, separate from investing in it. So where does this tool belong for someone in the second half of life? Honestly, in a very small box, if at all, not the foundation, not the income. The pure speculation corner. Money you have genuinely made peace with losing entirely. If the most established names, Bitcoin and Ethereum, interest you, that's a more defensible starting point than chasing obscure coins that behave like lottery tickets. But the size of the bet is everything. A 2% position that goes to zero is a story you tell at dinner. A 20% position that goes to zero changes your life. You don't need more money. You need a better plan. And a plan that survives a bad year is worth more than one that needs a perfect one. So we've covered the high skill bet, the income tool, and the wild card. Now the opposite of all three, the asset that pays you nothing, grows slowly and has quietly protected wealth for thousands of years. The one whose entire job is simply not to fail when everything else does. Gold is next. Now the strangest tool in the box, the one that pays you nothing, does nothing, produces nothing, and has been trusted for longer than any country currently on the map has existed. Gold. Let me say the disappointing part first, because it's the part that matters most. Gold generates zero passive income, none, not a dividend, not interest, not rent. Unlike a stock, a REIT, or even a staked coin, gold does not produce a single cent while you hold it. It just sits there. A bar of gold in a vault today will be exactly 1 bar of gold in 20 years. It doesn't work. It doesn't grow a business. It has no pulse. So why has nearly every civilization for thousands of years agreed it's valuable? Because that stillness is the entire point. Gold is what people reach for when they stop trusting everything else. When inflation is quietly eating the dollars in your account. When the economy looks shaky and the headlines turn grim. It's called a safe haven for a reason. Not because it grows your wealth, but because it tends to hold its value when other things are losing theirs. In that same 4-year experiment, $100 in gold became $140. A 40% gain, solid, unspectacular, steady, nowhere near Bitcoin's fireworks. And that contrast is the lesson, not the disappointment. This is where most people get it wrong. They look at gold's modest return next to crypto's explosion and conclude gold is the inferior investment. That's comparing a hammer to a fire alarm and asking which drives a nail better. Wrong question. Gold's job was never to grow fast. Its job is to still be standing when something else falls over. The cost of holding it, economists call it opportunity cost, is real. While your gold sits quietly, that same money in the broad market might have compounded into far more. You pay for the insurance by giving up some growth. That's the honest trade, and it's a reasonable one for the right slice of your money. A quick word on how to actually own it, because there are 2 doors. The first is physical. coins and bars. Simple to understand, but you have to store it somewhere safe, and you'll often pay a premium, especially on jewelry, where you're partly buying craftsmanship, not just metal. The second door is a gold ETF, a fund that tracks the price of gold without you holding the metal at all. A few clicks, no safe, no insurance, easy to sell. For most people in the second half of life, the ETF is simply less hassle. I'll mention one thing you sometimes hear about physical gold, that it can quietly carry wealth across borders. I want to be careful here, because that's often framed as a clever advantage. In reality, it comes wrapped in customs rules, declaration requirements, and genuine risk of theft or seizure. It is not a loophole. It's a liability with extra steps. I'd file it under interesting to know, not strategy to use. So where does gold belong? It's a defensive tool. Medium risk, zero income, slow growth, real protection. Picture a couple, 61, who lived through watching their accounts drop by a third in a single bad year and never want to feel that helpless again. A modest gold position, a small percentage, not a fortress, can be the thing that lets them sleep through the next storm without panic selling everything else at the bottom. And panic selling at the bottom, not the crash itself, is what actually destroys most retirements. That's the quiet value of an asset with no pulse. It doesn't make you rich. It keeps you calm, and calm is worth more than people realize, because the worst financial decisions in history were all made by frightened people in a hurry. Now look at what we've built. 5 tools, 5 honest jobs, the high-skill accent, the income producer, the wild speculation, the defensive anchor. 4 specialists, each excellent at one thing and dangerous at the others, which leaves one final tool, the one I've deliberately saved for last. The unglamorous, boring, almost embarrassingly simple option that for most people over 40 quietly does the heavy lifting the other 4 can't. And it's where the whole blueprint finally comes together. Here it is, the boring one. The tool with no story worth bragging about at dinner. Index funds. Let me explain it the simplest way I can. Instead of betting on one company and praying, an index fund lets you own a tiny piece of hundreds, sometimes 500, of the largest companies at once. Apple, Microsoft, Amazon, all of them in a single purchase. You're not guessing which horse wins. You're quietly buying the whole track. When one company stumbles, 499 others are still running. That structure, diversification, is the closest thing to a free lunch that honest finance offers. In that same experiment, $100 in an S&P 500 fund grew to about $180, a 79% return. It didn't win the scoreboard. Bitcoin's number was bigger. But it did something Bitcoin can't promise. It delivered a solid result without asking you to study financials, time a market, guard a digital wallet, or stomach an 80% drop. Historically, the S&P 500 has averaged somewhere around 8 to 10% a year over the long run. Now, I have to keep my promise to you and stay honest, because some people oversell this exact tool. You'll hear index funds called very low risk. That's not quite true, and the distinction matters at your age. They remove concentration risk, the danger of one company sinking you. They do not remove market risk. In a bad year, a broad index fund can still fall 30, 40%. It has and it will again. The protection is real, but it is protection against picking the wrong company, not against the market having a terrible year. Anyone who tells you otherwise is setting you up to panic at the worst possible moment. This is where most people get it wrong. Before I show you how it all assembles, one honest request. If this is the first time someone has explained these trade-offs to you without trying to sell you a coin, a course, or an app, subscribe. That's it. No urgency, no countdown. This channel exists to say the things the industry won't, and subscribing is simply how it survives long enough to keep saying them. Now, the part the whole video has been building toward. The final piece of the blueprint. It isn't an asset at all, it's the order. Watch how the 4 specialists snap into place around this foundation. Index funds are the foundation. The largest share, the long-term growth engine, the part you genuinely can hold for 10, 20, 30 years. REITs bolt on for income, sized up later as you shift from building to drawing down. A small stock position for genuine conviction, your accent. A modest gold slice as your defensive anchor, your sleep-at-night insurance. And crypto, if at all, in the tiny speculation corner. Money you've already made peace with losing. But sequence is the lever nobody shows you. Remember what we said at the very start about the order years arrive in? The same logic governs how you build. In your 40s and early 50s, you tilt toward the growth foundation because you still have runway. As you approach the second half, you deliberately shift weight toward income and stability. Not because growth stops mattering, but because a bad year hurts far more when you're about to draw on the money than when you're still adding to it. The assets barely change. The proportions change with time. That's the blueprint, not a hot pick, a shift in balance, matched to where you actually stand in your life. If you fix this, if you stop asking which one wins and start asking what job, in what order at my age, everything changes. The anxiety quiets. The math starts working with you instead of against you. And here's the quiet truth underneath all of it. A 55-year-old who understands sequencing will almost always end up safer than a 30-year-old chasing the next NVIDIA. Starting later is not the same as starting wrong. In the next video, I'm going to take this apart at the dollar level. The specific account order that decides how much of all this growth you actually keep versus hand to the tax bill. Because the container, as I promised, often beats the contents. That's where the real money is quietly won or lost. There's a scene I want you to carry with you after this video ends. It's an ordinary Tuesday, some years from now. 2 people, both the age you'll be then. Same starting savings as you have today, same 5 tools available to both. From the outside on this Tuesday, their lives look identical. Here's the first one. He's at his kitchen table at 6 a.m., refreshing a screen. He chased the thing that climbed fastest, moved real money into it at 56 because a video promised him a number. It's down 60% now. He's selling at the bottom, the way frightened people always do, locking in a loss he'll never fully recover from. He did everything the scoreboard told him. He picked winners, and the order he did it in, big bets, late with no anchor underneath, quietly took the back half of his life apart. Not because he was foolish, because no one ever told him the order mattered. Now the second one. Same Tuesday. The market is having an ugly year. Her foundation is down too. The same brutal percentage. But she's not at the screen. She's outside. Because she knows the growth funds are the part she won't touch for years. The income is coming in regardless. The small gold slice is doing exactly its job, letting her ignore the headlines. The speculation corner could go to 0 today and her dinner wouldn't change. She didn't earn more than he did. She didn't pick better companies. She built in the right order, and the order held when the storm came. That's the whole thing. The difference between those 2 Tuesdays was never the assets. It was the sequence. It was the plan. So before you close this, I'm going to ask you for 3 things. First, subscribe. Because the financial world is loud with people selling you the fast climb, and you could use at least one voice in your week telling you the unglamorous truth. Second, share this with 5 people, not strangers. The 5 you'd actually want sitting in that second kitchen, calm, on the bad Tuesday. Someone in your life is quietly afraid they started too late. This might be the thing that reaches them. Third, leave a comment. Tell me your age and the one tool you've been getting wrong. I read them, and the honest ones shape what I make next. And then carry this out with you. You were never behind because you lacked money. You were behind because no one showed you the order. The order is learnable. You just learned it. You don't need more money. You need a better plan, and now you have the blueprint.